For this video, I decided to run an experiment to see what happens if you invest as little as £5 per day for an entire year. In fact, that's how I started investing, by putting in even less than £5 a day. And now I'm on the path to building quite a large investment portfolio. So I want to show you that anyone can build wealth over the long term, even if they start by investing small amounts each month. But that raises the question, why would anyone choose to invest such a small amount? Most people feel like investing requires putting a lot of money in to get a lot of money back. So how could investing only £5 a day benefit you in any real way? Well, let's find out, and let me just tell you, the results of this experiment will blow your mind. To keep things straightforward, I've based all calculations on an average annual return of 8%. This is consistent with the long-term performance of global index funds. If you're unfamiliar with global index funds, don't worry, I will explain those shortly. Okay, let's run the numbers. If you invest £5 every single day for 1 month and achieve an annual return of 8%, by the end of the month your total will be £155.51. At first glance, this doesn't seem like much. After all, a single month isn't exactly a long-term investment horizon. So what happens if we extend this experiment to a full year? If you invested £5 a day for an entire year with the same 8% annual return, you would end up with £1,905, a profit of £75. Now, I know what you're thinking, that doesn't sound life-changing. And the truth is that many new investors feel disappointed when they don't see dramatic results after just 1 year. But the thing is that investing isn't something you do for just 1 year. It's a long-term commitment, spanning 10, 20, or even 30 years. The real results start to show over time, as you'll see in a moment. Personally, I view the first year as a crucial period for building the habit of consistent investing, helping you stick with it for the long run. Sure, the gains in the first 365 days might not seem like much, but if you keep going, that's when things really start to add up. So let's see what happens if we look at a real long-term investing timeline, rather than just 1 year. Imagine continuing this £5 a day investment for 10, 20, or even 30 years. To make it even more realistic, we'll increase the daily investment by 3% annually to account for inflation. Does this change the experiment? Not really. We are simply ensuring the value of your £5 investment remains consistent in real terms, as inflation erodes the purchasing power of money over time. This adjustment keeps the investment aligned with real-world conditions. If we were to invest for 10 years, our portfolio would grow to £30,868. And here is the best part. Out of that total, £10,228 is pure profit. You've only contributed £20,000 yourself. The rest is all interest working in your favor. I will show you later how you can make sure you pay zero tax on this profit, so make sure to keep watching. But meanwhile, let's continue with the experiment and see what happens after 20 years. After 20 years, that £5 a day investment would grow to an incredible £109,985. And guess what? More than half of that, £61,613, comes from interest alone. Pretty incredible, isn't it? There is a snowball effect starting to happen, whereby the more money you invest, the larger the interest you earn. This snowball effect is what's commonly referred to as compound interest or compounding. This is the process in which your returns accelerate over time because you're earning interest on your interest. Now let's see what happens if you keep going for another 10 years, making it a total of 30 years of investing. The results here are truly mind-blowing. After 30 years, our £5 a day investment would grow to an impressive £299,859. And guess what? Of that amount, £214,000 is pure profit, earned simply from letting your money work for you. This just shows what happens when you get into the habit of setting aside £5 a day in the first year and stick with it for the long haul. Now, you're probably going to have one of two reactions to this. Either you'll be pleasantly surprised by how much the investment grows over time, or you might feel disappointed that after giving up your daily latte for 30 years, you're still not a millionaire. Here is how I see it. For the average investor, investing isn't necessarily about becoming a millionaire overnight. It's about making your money work harder than it would sitting in a bank and protecting it from inflation. Of course, larger investments can lead to even greater results, but the point here is to show how small, consistent contributions can build real wealth over time. Now, what if £5 a day feels like too much? After all, £5 a day adds up to about £150 a month, and not everyone has that much spare cash. So what happens if you can only manage half of that? Would it still make a difference, or would you just be wasting your time and skipping your daily latte for nothing? Let's break it down. Investing £2.50 a day works out to around £75 a month. By the end of the first year, you would have a total of £952. Not exactly life-changing, but again, the first year is all about building the habit of saving and investing regularly. Now let's stretch this over a longer period. And as before, we'll increase the amount by 3% each year to keep up with inflation. Here is what happens. After 10 years, your £2.50 a day investment would grow to £15,434, with £5,114 of that coming from interest alone. Then in 20 years, things get serious, and you would have £54,996, with £30,808 of that as pure profit. And after 30 years, your investment grows to an impressive £149,000. Out of that, £107,000 is earned from interest alone. The point here is that investing as little as £2.50 or £5 a day might feel insignificant at first, but over the long term, it can have a big impact on your financial future. And here is the best part. If you're investing through a stocks and shares ISA, you won't pay a penny in tax on your profits. A stocks and shares ISA allows you to invest up to £20,000 a year completely tax-free. As long as you're investing through this kind of account, you won't owe any tax on the money you earn. Now you may be wondering, why should I even bother investing instead of enjoying my daily latte? Well, taking charge of your financial future is more important now than ever. With the state pension age being pushed further back and workplace pensions unlikely to cover everything you'll need in retirement, it's crucial to take matters into your own hands and start investing. So how do you get started? It's actually quite simple. First, choose an investment platform. Ideally, you'll want one with low or zero platform fees, such as Trading212 or Invest Engine, two of the most affordable options currently available. Next, open a stocks and shares ISA. Then pick your investment. Ideally, as a beginner investor, starting with a globally diversified index fund or something like the S&P 500 makes a lot of sense. Here is a quick explanation. The S&P 500 is essentially a list of the top 500 companies in the United States. While you can't invest directly in the index itself, you can invest in an index fund that tracks it. These index funds pool your money with other investors and spread it across all the companies in the index, making it a simple and effective way to diversify your investment. Alternatively, you could go for a global index fund. These invest in markets all over the world, including the S&P 500, the UK stock market, European markets, and more. The choice is yours, but I personally prefer global index funds because they give you exposure to growth opportunities in markets worldwide, rather than focusing on just one region. Once you've chosen your investment, the next step is to automate your contributions by setting up a monthly direct debit. And that's it. Keep that running for the next 30 years and watch your money grow. Now, if you're unsure how many index funds or ETFs to invest in, check out this video to find out if investing in multiple ETFs makes you more money than holding just a single one. See you there.